From the American College of Financial Services, welcome to Annuity Insights, in partnership with New York Life.
Welcome, everyone, to the Annuity Insights podcast. I'm Michael Finke. I'm a professor of wealth management at the American College of Financial Services, and I'm here today with Kelli Faust. Kelli is a corporate vice president at New York Life and also an actuary. And I'm also here with David Blanchett. He is the head of retirement research at PGIM, also an adjunct professor at the American College. And I would like to say an actuary wannabe. Is that correct, David?
100% correct. Just couldn't take those tests.
Kelli, there are so many questions that David and I, have wanted to ask actuaries over the years, and we're gonna pepper you with all of those questions over the next 30 minutes. Now, I'll start by saying David and I have actually done a lot of research on annuity pricing. And one of the things we found is that when we're looking at our estimates of expected longevity of the kind of people who buy annuities, that they're pretty generous. That the amount of income that you can get from an annuity is pretty close to what you would get if you built, say, a bond ladder to the average longevity of a higher income American. So why don't you take me through the process of how annuities are priced, and why is it that some of the quotes seem actually quite generous to us?
Yeah, so if we're focused purely on income annuities right now, there's a lot of different components that go into pricing an income annuity. And the first is the biggest one, which is mortality or longevity risk. And so each company or carrier is going to have their unique mortality assumptions, right? A lot of carriers develop their own mortality assumptions in-house based on their own experience. So they're really looking at, over the last however many years they've sold annuities, how has their own mortality experience unfolded? And so you're going to have a different mortality assumption for each carrier, depending on the clients they're selling it to, through what distribution channels they're selling it through, because different clients are going to go, buy through different distribution channels. And so that's one thing that's going to impact the price of an annuity or the payout that the client receives. The other big piece is going to be interest rates, right? Like, what can New York Life, for example, invest the premium in today to fund these future payouts later on? And as interest rates have risen over the last couple of years, carriers have been able to offer more attractive payouts because they can earn more on those premiums that they're investing to fund those payouts in future years. And so, depending on what the insurance company is putting that money in, what type of assets, it will have a different, ending result in the payout. There's also other things like expenses, commissions, and just like general, what profit margin the carrier wants to make. And so all of these things are going to result in a different payout. But I will say that when you're looking at the mortality assumptions specifically, you really want to focus on, who has that insurance carrier been selling to and how has that impacted their experience over the years. One example, for us at New York Life, we are constantly refreshing and revisiting that mortality experience to make sure it's really reflecting the latest that we're seeing.
Now, David, you and I use the Society of Actuaries annuity mortality tables, which I think make it appear as if annuity buyers are pretty healthy, right?
Yes. Well, healthy is relative. Healthier, much healthier than the average American, right? Than you would see in a mortality table using, like, for the Social Security Administration that covers Americans, for example. Yes.
And part of this is just that they have more money, and people who have more money tend to live longer. Kelli, when we're using those Society of Actuaries tables, how do they compare to the proprietary tables that you guys use?
Yeah, so one thing when you're looking at like the society's tables, right, those are not refreshed as frequently as what, the insurance carriers are doing, say New York Life, right? And so I think the last society table is actually the 2012 table if you're focused on annuities. And so it's pretty interesting, right? Because over time you would think that you have mortality improvement in general. I know the last couple of years we've kind of seen a reverse in this, but in general, each year mortality of Americans has gotten better and better. So I would say that New York Life's specific assumption is probably just more up to date than this than the, Society of Actuaries table. And also, it's going to cut it a couple different ways, right? So one thing that you had mentioned is generally annuitants have better mortality than just the general US population. And you can even dig down deeper, right? And look at how much premium is a client putting into an annuity. And that can kind of be a proxy for just like general net worth, which we know mortality is going to be a function of how rich someone is, just because typically the more money you have, the better healthcare you can afford, and things like that. So I would say the biggest takeaway is that New York Life's assumption kind of splits it a little bit more granularly than what you see in the Society of Actuaries industry table.
So I have a question. So to what extent do you all think about like product specific annuity mortality rates? So for example, like I always make the point like normal humans won't buy a deferred income annuity or like a longevity annuity. Like the average person who's an annuitant doesn't like wake up and say, hey, I want to buy a product that, in 15 years, if I'm still alive, starts paying me income. So you got to think that there's unique mortality assumptions embedded in different types of products, right?
Yeah. So like with our SPIA and DIA products, we are just using the experience from those SPIA DIA consumers to create that mortality experience, right? So like at New York Life, we sell a ton of different products. We sell SPIAs and DIAs, we sell life insurance. The experience used to develop our life insurance mortality tables is separate than the experience used to develop our SPIA and DIA mortality tables. And that really splits it out and controls for that client base, right? If we're just looking at those who have bought this product in the past and looking how that experience has unfolded. And one thing I'll say, right, is like credibility is an issue here, where do we have enough claims to really support and develop an assumption for all of these different little segments? And where we don't have that, we might leverage, some of the industry data a little bit more and wait until that experience unfolds. But because we're refreshing this so, regularly, we're able to, as we get more experience, just continue to refine and refresh it.
All right, so Kelli, I know that New York Life has different distribution channels. And there may be differences in mortality expectations among different distribution channels. And that begs the question, it's something that David and I have also noticed in the data, is that different types of annuity products might have different types of mortality distributions. So in other words, DIAs, as David mentioned, tend to be bought by actuaries and professors and dorky types who tend to live a long time. Other types of annuities might be bought by a different type of client. How does that affect pricing?
We actually have seen different mortality experience in different distribution channels, and this has just unfolded more recently, and it's been pretty interesting to see. Because if you just think about, an annuitant or, person who's trying to buy an annuity, would you think that their mortality would differ whether they buy it through, say, a bank or a broker dealer versus, say, in the agency channel? And I think our initial thinking was that an annuitant, regardless of channel, is going to have the same mortality experience. But what we have seen is actually differences by distribution channel, and we are starting to reflect that in our pricing. Now, when I say we reflect that in our pricing, it doesn't mean we're giving different quotes depending on where you buy it through, but it will flow through into our margins and into our financial models.
So how long do you estimate that a 65-year-old man is going to live if they have enough money to buy an annuity?
I think Social Security table is like, for a 65-year-old man, like, is it 83 or 86?
84.
Oh, 84. Okay. And then it's female 86?
No, female is 86, but then for an annuitant, how much different is that?
I don't think I have that answer for you, to be honest. I don't think I have.
Putting you on the hot seat.
But Michael, too, though.
We will say it'll be a higher age, right? It'll be an older age than that 84, but I don't have the exact, if you're using, 50th percentile life expectancy for New York Life's assumption, I don't have that off the top of my head.
But there's two key differences, right? One is that the Social Security table, it's a period table. It's not a cohort table, right? And that's all Americans versus people that have money that can buy annuities. And so you would think there'd be a pretty big difference, right, versus in terms of Social Security versus like any base annuity mortality table. I've got a question. Like which annuitants tend to be the least healthy? I have my guess on this, but I'm curious. Are there some that tend to be? I know it's not those that buy Dias, but is there a certain type that don't live as long on average?
I would say the biggest factor for us of what we look at, right, is going to be premium, because that's the biggest indicator for net worth. You have to remember for annuities, right, you can't underwrite these clients. It would be this weird relationship where you're underwriting someone and you're paying someone more for being less healthy. So we don't really have nearly as much information as we have about our annuitant clients as we have about our life insurance clients. And so I really think it would be, again, that like premium component that really gives us an indicator of the amount of money they have, in which case, their mortality is going to be a function of that. I will also say, again, just to say the distribution channel thing, there are pretty stark differences by distribution channel. And so that is definitely a key piece here.
No, David and I run quotes a lot on SPIAs and DIAs, and occasionally we will see that one insurance company is being very aggressive when it comes to pricing. And occasionally, especially with DIAs, we'll see enormous differences. So how do you explain some of those big differences in pricing? It's not necessarily related to credit quality. It can be that New York Life will pop up there on the top of the list, or another very highly rated insurance company. What's going on there?
Yeah, so I think there's a lot of pieces that go into pricing, and there's all this good math. You run these financial models and it spits out a result for a given target margin. But I think carriers aren't always pricing to target margins. There's a lot of other things at play. So they'll look at their competitive positioning. Sometimes it might just make sense to lean in more, whether they're trying to hit, sales goals or things like that. And so you'll really see the competitive grids kind of like ebb and flow of who's on top and who's not. Something else I typically see is that for those longer deferrals, we see much bigger differences in payouts across carriers than for shorter deferrals. And something I will say is like, as someone who's pricing these on a weekly basis, I can't go in and say, hey, I want male 65, 20-year deferral to be at this payout, right? It's all a function of all of these other inputs. So while mortality is a key piece, another key piece is going to be your crediting rates that you're putting in, right? And those typically vary by duration. And so that'll be another piece, right? Like what is New York Life earning at a 20-year investment? What is New York Life assuming as a reinvestment rate, right? For an annuity like a fixed defer annuity that's much shorter, it's a 5-year period, there's no reinvestment assumption. For something like a 20-year, there is that reinvestment assumption, and I think that's going to vary a lot by carriers. And then something else I'll add, I'm kind of going back and forth here, but on the mortality pieces, we know our mortality assumption today, but we also have to make an assumption about mortality improvement. Is it going to get better? Is it going to get worse? And for these longer duration products, that's going to impact those cells more. And so you might see things swing a little bit more for those longer duration products.
Well, so and this there's like a theme behind one of my questions. And so I'd like to think that moving forward, it's going to be possible to create products or solutions that somehow induce retirees who are less healthy to want to buy them. And so to me, there's this interesting kind of potential around product design where you could have products that have features like liquidity, like our living benefit structure, that could have payouts that are just as attractive or more as, products that are irrevocable like SPIAs and DIAs, to the extent we can begin to induce more Americans who aren't as healthy to buy them. Do you have any thoughts on like what those structures might look like in the future that you could get that would, kind of actually just economically dominate what are often viewed as the best annuities just because more folks are willing to actually buy them?
So I guess I would challenge that. How do you think about a SPIA or DIA with a cash refund benefit? So I know the annuitant doesn't benefit from it, but if they do die before, they've gotten their return of premium, their beneficiaries would. So I feel like that helps a little bit with that, risk of, oh, I'm super not healthy. Should I really be putting my money here?
Well, so only about 15% of annuities that are sold are life only. So I think that the notion of life only risk is actually somewhat rare today when it comes to SPIAs and DIAs. I'm more curious though, to the earlier point, like the average American is not going to go out and buy a DIA, right? People that buy DIAs are going to be naturally healthier, and therefore that changes the mortality component. If we think about interest rates and mortality, but what I want to do is get, and this isn't possible, but like the annuity mortality tables, whenever they update them, to resemble, the Social Security tables more. And I think that, products like SPIAs and DIAs probably aren't the best way to do that. I think that there's other things that you can add to a product that might make them more attractive to the average American. And the more that you induce the average American to buy an annuity, the more attractive, in theory, payouts can become for everyone. Does that make sense?
Yeah. So we do have, I don't think that you are ever going to land at a place where your mortality for like annuity products is going to converge with mortality for Americans as a whole, just
right.
because of the like, you have money, even if there's a liquidity, you still have $100,000 put into it. But there are products where there is liquidity, right? FDAs with GLWBs. We look at the FDA with GLWB payouts relative to SPIA and DIAs, and we call it the cost of liquidity, right? The difference between the payout you're getting on a SPIA DIA relative to the payout you're getting on an FDA with GLWB is the cost of liquidity. You're getting a higher payout because you're giving up that liquidity. And we look at that pretty frequently. And we have, a lot of information around what does that cost of liquidity need to be, where you start to actually see a shift from these SPIA DIAs to FDAs with GLWBs. And I think it sits somewhere probably around like 2%, where really people start to value that liquidity. Now, again, this is still within the consumer base of people looking for annuities. So they're kind of still deciding SPIA, DIA, or this. But I do think it shows that there's a way to, as that cost of liquidity decreases, can we make the pie bigger, right? Not just shift the pie from these illiquid to more liquid products, but can we make this attractive enough to make the pie bigger? And I think we're starting to see, GLWB products across different chassis, and they are starting to gain some traction. There's another whole policyholder behavior component of this that goes into pricing. How is the policyholder going to withdraw? When are they going to withdraw? Nothing is set in stone at the time of purchase. And that creates all of these other, considerations that go into pricing in terms of asset liability management that can actually, in some cases, possibly bring down the payout. So you really got to balance all of that. But to get at the core of your question, how can we create products that make the consumer base bigger? Part of me honestly thinks it's education. I really do think, I'm big on this idea of build your own pension by just purchasing dollar cost averaging into DIAs over time with little bit amounts. So could you lower, the minimum premium to $100, and somebody can just invest $100 every week into this if they want. But I think, again, there's a lot of work to be done around the benefits of these products, the benefits of mortality pooling. You can't really replicate mortality pooling with any other financial instrument. And that's what the insurance company is there for. I think that piece needs to be communicated and a little bit better, and there needs to be more education around that in order to really expand the market.
As the baby boomer retirement wave crests, it's time to position yourself as the ideal partner for this growing pool of clients with the American College of Financial Services Retirement Income Certified Professional designation. As an RICP, you'll get the specialized knowledge to help more clients with complex retirement planning needs. With the convenience and flexibility of the latest in e-learning design, the RICP delivers applied knowledge from over 45 retirement experts on Social Security, taxation, income planning, Medicare and Medicaid, long-term care planning, and more. Get started in our 3-course program today and become an RICP in 12 months or less. Now is the time to strengthen your client relationships with deep expertise to address the unique challenges of retirement. See how you can expand your opportunities at theamericancollege.edu/RICP.
If you are enjoying this content, please check out the New York Life Annuities Education Center designed to support you in growing your annuity business with the tools, insights, and resources you need. Visit the Advisor Education Center at NewYorkLifeAnnuities.com.
Kelli, no, there's a lot of talk these days about the incorporation of annuities into defined contribution plans. And it really gets interesting when we think about annuities and defaults. Because as David said, we want to get more Americans to participate in annuitization. It's certainly better for everyone, including those who expect to live longer. Do you see, now what is rate setting going to look like? Because on average, DC contributants, people who are participating in a DC plan, they actually tend to live longer than the average American. So they're probably closer to the average annuitant. Do you think there's going to be much cost savings if you start seeing more annuities showing up, especially in defaults?
Yeah, I mean, I think the defaults will create, again, more people buying these annuities earlier on than they otherwise would have. I agree that their mortality is likely going to be better than the overall population. But the way I see it with these target date funds, again, you still have this optionality. So maybe, yeah, everybody just does the default option and 90% of people don't actually move their money once it's placed, but there still is liquidity to that, and that all needs to be reflected in the pricing. Somebody could say, hey, I want to move out of this at any point, and it just makes it more complex than your like vanilla SPIA and DIA. So I think from that standpoint, the like ALM component, asset liability management, is a little bit more complicated. But I think from a mortality standpoint, yeah, you would probably sit somewhere between the general population and maybe the annuitant population in the retail market. Just because as younger people are buying this, they might not know actually how healthy they're going to be at the time where you would start seeing, more deaths.
Michael, I would expect that mortality will increasingly move towards general population mortality as more Americans are using 401k DC plans versus, historically it was only those that had lots of money. I mean, obviously there's still gonna be a difference between those that have a job and those that don't. But I think we're going to see that, I would imagine, become more attractive into the future.
It has been one of the questions right now, because if you buy an annuity right now, you're in a pool of relatively long-lived annuitants who probably look a lot like you. So it's priced fairly. Let's talk a little bit about pricing, because we touched on that at the very beginning of our conversation, but it's something that I think especially a lot of financial advisors don't really grasp how attractive annuity pricing can be. They say things like, if you go on Dave Ramsey, he'll say that annuities are laden with fees, but products like SPIAs or DIAs are just spread products, so there's no fees associated with them other than the profit that the insurance company has to build in when they're making those quotes. And when you look at those quotes, there are a lot of companies also that are thinking about introducing, for example, treasury bond ladders in a single ETF format. And so if you're an advisor and you're thinking, all right, I can create a stable income with treasury bonds up to age 90 or age 95 or age 100, the annuity quotes to the age of, say, 90, which is pretty close to the average longevity, the annuity quotes are actually going to be more attractive. So in other words, you will be able to generate more income per dollar. And it seems like one of the reasons is because the insurance company assumes that they're going to be able to generate a rate of return on bonds that's higher than treasuries. But that in the world of finance, that is highly controversial, because they're assuming a credit premium. And historically, the credit premium has not been terribly reliable. And so you're essentially getting something. You're getting a reward for taking risk, but you're not actually taking the risk. It's the insurance company that's on the hook for generating that credit risk premium. That is a really interesting concept. And I think it's one that a lot of finance geeks would kind of raise their eyebrow at and say, gosh, that is actually really attractive.
At the core of spread-based annuity products, and you hinted at this earlier, right? Like New York Life or any insurance carrier is making money by crediting a policyholder something, taking that premium, investing it, and earning something ideally higher than what they're crediting, right? And they earn some spread. Now that target spread is going to vary by carrier. It's going to vary honestly by like month or year. There's going to be a lot of things in how an insurance company sets that target spread, but no fees involved in your vanilla SPIAs, DIAs, in your fixed deferred annuities, or anything like that. Then the question of how much can the insurance company actually credit the policyholder comes down to what can they earn on that premium that they're investing. And to your point, it's going to be some risk-free rate plus some, credit spread. And depending on how risky the insurance company is comfortable getting their basket, they're going to earn more. Typically, when you earn more, that's not free. There's additional risk that comes with those assets. But really, that's what's going on here. And then the other piece is this mortality pooling, right? Which I mentioned, you can't really replicate this with traditional financial instruments. And that's the piece where you're kind of paying out those who live longer the money of those who have died sooner in your pool. And so you have those two pieces. But yeah, like once the income payout is locked in, that is what the insurance company is committing to that person for the lifetime, the duration of that contract. So any performance in assets that happens, New York Life or the insurance company is on the hook for that, right? And certain insurance companies are more comfortable with a riskier basket, and other insurance companies are less comfortable with that. But depending on the risk appetite of the company, the rating of the company, and all that good stuff, it's really going to impact what they can earn on those premiums. And again, that is really what feeds into what they can then credit the policyholder.
I mean, David, this is an interesting concept because if you're an advisor and you're thinking of maybe buying a zero coupon treasury ladder to create income, you can probably get more income to your client's average longevity, even if they didn't spend $1. You get more income to their average longevity through the use of an annuity. And if you're getting it from a very highly rated insurance company, then things like, the risk to the policyholder are pretty minimal. That almost seems too good to be true.
I mean, it does and it doesn't. I mean, I think that's just the mechanism of insurance, right? I think that we've created a structure in our country that allows for these large institutions to take on risks that individuals couldn't take on effectively on their own. I think that, Michael, people push back on us, like when we've done the research looking at, how the kind of the money's worth of these SPIA payouts have varied over time, they'd say, oh, you shouldn't use treasury bonds. And I would say, well, I think that's probably the best proxy for the kind of guarantees you're going to get from an insurance company if you're doing it on your own. So I think that there are these kind of unique aspects to how insurers can create income that you just can't create on your own given idiosyncratic risks.
Kelli, can you give us a very quick explanation of what a mortality credit is?
Yeah. So mortality credit is what you are getting paid for pooling mortality risk together as the insurance company is doing. And so you are paid a payout in a mortality credit because other people are dying earlier on and they're not getting payouts. So you're kind of taking their payout and then dividing it among those who are still alive in a way. And as you get older, actually, you can, each year that you get a payout, you can split that payout into different components like interest credited, return of premium, and mortality credit. And that mortality credit component gets bigger and bigger the older you get and the more payouts you're getting.
And it's one of the reasons that the actuaries and the economists are the ones who buy the deferred income annuities, because they understand that mortality credits are biggest later on in life. But it is really one of those products that has a limited appeal to those, and they are actually a lot more appealing also to asset managers, because asset managers can basically get rid of that idiosyncratic longevity risk and give up a relatively small percentage of their managed portfolio. So it is an interesting concept. You can get rid of idiosyncratic risk that way, longevity risk, but there's also, as you mentioned, this systemic longevity risk that you're also transferring to an institution. And that systemic longevity risk is the chance that, maybe AI is going to come up with a cure for cancer. And if that happens, people are generally going to live longer. And that's a risk to you as a retiree, because if everybody's going to be living to 110, then retirement is going to be a lot more expensive. If I can transfer that to an insurance company, that's a way of taking a risk off of my retirement balance sheet, transferring it to an institution that can bear that risk. And let's talk a little bit about New York Life's or any insurance company's ability to bear that systemic longevity risk, can we view that risk as being partially hedged by life insurance? Is that the way you think about that?
So, in short, yes, right? There's definitely some natural hedge between life insurance and annuities. Life insurance pays out when somebody dies, and annuities continue to pay out as somebody lives. So if somebody dies, they get a life insurance payout, but they don't continue to get their annuity payouts, right? So there's like this offset in cash flows. But I will say that COVID-19 was kind of a great case study for this. And we actually did not see, as an industry, as much of an offset as maybe people would have thought. And there's a couple of reasons for this. The first is that the demographics of the people buying the products are different, right? The life insurance consumers and annuity consumers don't completely overlap. So when we saw this huge increase in claims, for a percentage of those people, we did not see that offset in annuity benefits being paid. The other piece is the timing of cash flows, right? So the life insurance, when somebody dies, they get a lump sum at that point in time, where really the savings from annuities after somebody dies happens over time, right? Because we were going to continue to pay that annually, monthly, whatever it was, until the annuitant passed. So then the third piece is that income annuities are also just a smaller portion of the overall annuity space. And so from a pure, volume, AUM in force, or just like, total amount purchased, you're not going to have that perfect hedge. But there is definitely some hedge. A lot of carriers in the industry saw it in general when there was a huge spike in claims because of COVID, there were less annuity payouts. And having that natural hedge is definitely helpful, for New York Life and other carriers who offer both of these products, just in terms of like balance sheet mortality risk and all of that stuff.
David, do you have a question?
I mean, maybe first comment, and Kelly can agree to disagree, but like, I think that, Michael, if there is if we solve longevity and everyone lives to 110, like, I would imagine that the insurers are going to have to kind of claw back on some of the claims. The point is you're still better off than if you did it yourself. I don't think it's reasonable to expect that, they'll be able to make everyone whole because they would go bankrupt. But to me, honestly, looking forward, where I see the value of protection growing is just the increasing variance in longevity, right? As we see more people living to 100, 110, 120, then self-insuring becomes just incredibly expensive. And so I think, I don't expect to see everyone living to 110, but I do expect a lot more Americans to be living longer. And so I think that's where and why in the future, I think having more protection will become more valuable. Even if we don't see massive gains in life expectancy or the average, it's that tail risk that I see moving and growing in the future. Kelly, do you agree, disagree?
Yeah, no, I completely agree. And I think that tail risk is exactly what insurance is for, right? Like in all cases, you buy a vanilla term product, you're really trying to protect yourself against that term risk of maybe dying younger than you would have expected, or than your, mortality tables expect, to help your beneficiaries out in that case. And I think that's exactly right with annuities. I think sometimes people don't think of annuities as insurance, but when you really think about it as pure longevity insurance, which is SPIA and DIA is, it's really to protect against that tail risk and make sure that that you don't run out of money. So I completely agree.
Kelly, David, thank you so much. This was a fantastic conversation. And thank you, everyone, for joining us for another episode of the Annuity Insights podcast.
Thank you.
See y'all.
Thanks for listening, and we hope you join us on future episodes. Annuity Insights is a production of the American College of Financial Services. Annuity Insights is produced and owned by the American College of Financial Services with generous support from New York Life Insurance Company. Accuracy of information is subject to change, taxes, legal, rates, etc., but believed accurate as of the time of recording, January through April 2025.